Because there's a lot of noise out there. In terms of my question too for viewers, especially for those that do it themselves, is where do you get your information from? Your research, if you would. Is it somebody from a talk show? You know what I'm saying? In terms of where they've never managed people's money before, or people that are managing people's money. I mean, that's what we are. We are a wealth management company. And again, people worked extremely hard for their money. I mean, but again, it's just setting the tone and putting a plan in place and sticking to it. And if you do that, you can find success in some areas to accomplish your overall investment needs.
Right, and and there will always be something to worry about.
Right.
There's always, a political situation or a geopolitical situation.
A pandemic.
Things we're not expecting that just pop up.
Right.
There's always something you can find to be worried about. It's just very important to keep that long-term view. And remember, the long-term happens over a long period of time. And that month-to-month, day-to-day can be volatile, but keeping perspective.
We also have a really good chart that we wanted to share with people in terms of, not, spending time in the market, not trying to time the market. Tommy, let's talk a little bit about that just to kind of, prove our point.
Yeah, and this was 5 individuals. They invested $2,000 annually over a 20-year period. And they worked down from timing of when they tried to time the market. So Peter, he was perfect. Found the low point.
Perfect timing.
we showed that chart, and there was a down point every year.
Sure.
Some drawdown. He found that bottom point every year.
He was perfect.
You can see what his account did.
Yep.
Ashley was not certain, knew she couldn't time anything, and so she invested on the first trading day of the year.
Okay.
Matthew said, well, I don't know if I want it all in at one time, so he's going to go and average his $2,000 monthly to get his $2,000 limit. Rose was terrible. She found... Over that 20-year period, she found the high point of every year.
Yep.
And Larry didn't want to do anything, and so invested in a T-bill or a cash-like substitute. Was just afraid to be in the market. So you can see the large discrepancy, between the first 4 and Larry.
Yep.
There is some variation among the first 4. Obviously, if you're perfect at market timing, it's going to be better. But just time in the market, not timing the market, is important to long-term success.
That's right. I mean, you know what, too? I mean, everybody has a different, and that's okay. Your peace of mind goes a long way. And so, being in the market isn't for everybody. I mean, it's just not. There's some people that just want to be in a CD or some type of fixed instrument, and that's fine. If that gives you peace of mind, who am I to tell somebody different? But there's also people that, hey, like with our clients, they want to make a decent rate of return, and they just don't want to lose a lot, and they want to keep up with inflation. I mean, that's what our people are looking for. And there's some, especially if they're younger, that want to be more aggressive, as you should be, because you're building wealth. But as you near retirement, you have built your wealth, and you're moving into that distribution phase rather than the accumulation phase of retirement. It's kind of that go-go year, right? We always have fun with that.
In terms of go, no-go.
That's right. Go, slow go, and no-go, right? Well, I like the go. But that's also why, Tommy, you need to have a diversified portfolio. You can't just be in one stock or one company. You need to find balance in terms of what you're trying to accomplish with your money.
Yeah, you want things that work at different periods of time. If you get too far to one side or too concentrated in a certain market or sector or stock, it can work well for a long period of time, and then, you get a headline risk or, a significant drawdown affecting all the same companies, and your portfolio returns will reflect that. So it's important to, find a balance in there and look for different types of instruments, whether that's, stocks or international or bonds or corporate bonds or treasuries, CDs, money market, fixed products, like you mentioned. It's finding a balance and finding things that work at different times, you can attempt to smooth out some of that volatility.
Right, because every single product or security is doing something different for you in terms of what you're trying to accomplish. I think the whole point is your portfolio, what is the makeup of your plan? And you know what, we meet with a lot of people. The question is, do you know the makeup of your plan? Or are you just trusting in somebody to do that? I mean, you don't want blind trust, but you need to know what you're in, especially because today's segment is on market volatility. Thanks for watching Retire Vivid. Want to see more? Like and subscribe to our channel to stay up to date with exclusive Vivid content. Plus, be sure to watch our show Retire Vivid every weekend. We're here to help you get retirement ready.